So our next panel is about exploring new commercial asset classes. A lot of you guys are really involved with multifamily, but you're curious about other stuff. So we brought up 4 people who know a little bit about commercial, more than a little bit about commercial. They have almost $1 billion of assets under management combined to talk about commercial in the non-multifamily arena. So first, Kevin Bupp is a Florida real estate investor, top iTunes podcast host, and serial entrepreneur with over 40 million of real estate transactions. His extensive investment experience spans the gamut of apartment buildings, single-family homes, office buildings, raw land, condos, and his favorite and by far the most profitable, mobile home parks. Please welcome Kevin. Thank you so much for being here. Mark Macia has over 12 years' experience in real estate and has been commonly featured in the New York Post, New York Real Estate Journal, The Real Deal, and the Cincinnati Business Journal. He's principally responsible for managing the investor relation activities of Macia Development, which has $500 million assets under management and currently concentrating on medical, office, and retail. Please welcome Mark Macia. Dennis Quinn is the owner of Sunny Slope Estate Assisted Living in North Glen, Colorado, a 32-unit assisted living facility with an uncanny ability to cash flow in the niche low-income sector. 14 years experience in assisted living. Please welcome Dennis Quinn. And last but certainly not least, founder of Self Storage Profits, Inc., and host of Self Storage Holding Companies, which syndicates, acquires, develops, and manages self-storage facilities nationwide with over 3,500 units and over 30 million assets under management. Also continue to grow their information education company to teach others how to replicate their success with self-storage. Please welcome Scott Myers. Cool. So this is the first panel that we're having, so a little bit of lay of the land. We're going to have a conversation amongst ourselves, and about halfway through, you guys will have a conversation with these folks. This is going to be the longest session because I have a feeling that you guys want to know as much about these asset classes as you can, so I want to leave as much time for questions as possible. But to start things off, I'd like to start with you, Dennis. I'd like to ask you, what is different about assisted living residences versus your typical residential property? And I'm asking you this because you've been a real estate broker for many more years than you've been doing assisted living. So when you're investing in assisted living, what is the major differences between ALFs and single-family homes?
I think probably the biggest thing that you need to consider if you're going to get into this market is it's really 2 different components. It's owning the investment and running the business. Now, I happen to do both, but you may not want to do both because, running an assisted living home has a lot of government regulation. You're taking care of people's grandmas. People tend to be sensitive about how you take care of their grandma. So, you have to decide how heavily into it. My wife and I have a passion for this. We want to continue to operate them. However, as we grow, and we are in the process of some pretty aggressive growth plans, we are going to bring in some management teams because you can't be all things to all people, especially while we're in our growth mode. But there is an investment component with regard to real estate, and then there's the operating the business.
So is it possible to invest in assisted living without having to be the operator yourself? And if
Absolutely.
So, how would you do it?
I think there's a lot of people, every state is different, okay? And on the East Coast, in Colorado, we have small neighborhood assisted living homes. People buy a residential home by right of use. Pretty much in any jurisdiction, you can have 8 people in a residential home under assisted living. There's pros and cons to that. I'd be happy to share my thoughts on that off the stage here. But there's a ton of those people out there who are qualified and want to grow their business, but don't have the wherewithal to own the real estate. So, and it doesn't have to be a small residential 8-bed facility. However, those are the people who have the experience to grow into something bigger and manage it for you. Either they own the operation or you own the operation and they just manage it.
Awesome. So the transition from assisted living, or from residential to assisted living, is really just about having a good team of people.
Yeah, sure. I mean, we hire people for their heart, okay? I'm most concerned with your ability to respect other people and care for other people and have that caring mentality. I can teach you the mechanics of running an assisted living home. I can't, I have this saying I've said for years and years and years, even when I was in the food industry. I can't teach you things your mother should have.
I like that.
Okay? Your mother should have told you how to care for other people and how to have that caring attitude towards others. That's something that, I'm not going to be able to teach you. Nobody can teach somebody else that. So I look for people who have that in their personality. I can teach them the business.
Awesome. So I think all of you guys have more or less started with residential at some point, whether it was single family or multifamily. But Kevin, I want to focus on you next. How did you land on mobile home parks, transition from residential assets to mobile home parks? What's the story there?
Yeah, so I'll try to condense it. I focused on single family when I started my business and built quite a large portfolio and transitioned into multifamily. This is back before 2008 happened, and then 2008 happened. And 2008 crushed me, and I lost a lot of my single family homes. It wasn't a scalable model for me. It was very inefficient with the management. And so I knew that when I was going to rebuild things, I knew that I was going to go in multifamily again. Multifamily, my multifamily property survived the downturn. And I knew that when I was going to rebuild, it was going to be multifamily because it was scalable and I could really grow the lifestyle and the empire that I wanted much quicker and much more efficiently with multifamily than single family. So as I was going on this journey of rebuilding, I was talking to as many people as I could, finding out what the 2010 landscape looked like. What were people doing then that they were doing differently from 2008 and prior years? And I was introduced to a gentleman that he was a mobile home park financier for 30 years. I worked at a bank, and he retired and started buying mobile home and RV parks. I had lunch with him. I didn't even know what to expect from the lunch. And I walked away there 2 hours later saying, I'm going to focus on mobile home parks. So there were some very unique attributes that exist in mobile home parks from an investment standpoint that weren't in the multifamily space, and I felt that that I should put some focus to see if I could make it work and achieve the results that he was saying were possible. So that's how literally that lunch is what transitioned me. There were some very, very unique components of mobile home parks. There's a massive barrier to entry. They're not building them anymore, and so it's literally the only commercial asset type that has a diminishing supply. So they're not building them anymore, but they're actually getting torn down faster than they're getting built. And so it's the only one that has that insulation factor. I don't have to worry about competition.
So I want to drill into that. It's the only asset class that has a diminishing supply versus a growing supply.
That's correct.
Of all the assets that we're talking about on stage. What is the reason to get into mobile home parks if you're not already in it? Is there a reason?
Yeah, there's some unique components. For instance, most parks, the tenants own their own home. So you're basically renting a parking lot. Is the easiest way to put it. You're renting the land. Some components will have rental properties in there or rental trailers that we own, but majority of the times you actually are just renting the land. And so what that means is they own the home. So you don't get calls about plumbing issues, electrical issues, roofing issues, anything like that. They fix it. They own the home. They just rent the dirt from you. Another big benefit of that is that they can't just pack up their backpack and put their mattress on their rooftop and leave in the middle of the night.
Yeah.
Because they've got a home that's very expensive to move. So it costs about $3,000 to $4,000 to move a single wide home. And so we don't have a lot of turnover. So it's a very unique attribute of mobile home parks that does not exist in multifamily properties. So multiple other things as well, the returns, comparing apples to apples, which is kind of hard to do with multifamily and mobile home parks. But if you could compare apples to apples, you can typically expect about a 1.5 to 2 point, sometimes higher yield premium as far as returns are concerned.
So it's easier and you get more cash flow.
Yeah.
But it's harder.
Now everyone's going to do mobile homes.
If you buy right. As with anything, if you buy right? Because I look at hundreds of parks on a regular basis, and I would never buy them because they're overpriced. So I would not get those returns.
Right.
So as long as you're buying right, typically, again, in every market we're in, if I went and bought a multifamily property right now, I definitely can achieve a lot more as far as returns are concerned with my mobile home parks than I could by buying a multifamily property there.
And how long have you been doing mobile home parks now?
So 5 years I was introduced to it. It took me like a little over a year to buy the first park, and so really 4 years of active investment.
4 years. And how many lots do you have now?
Just over 1,000.
Just over 1,000 lots in 4 years. Wow.
Yeah.
Awesome. And where are you going with it? What's the goal for 2017? I'm going to ask all you guys the same question too.
We have very conservative goals. We'd like to add 500 lots to our portfolio. We currently have over 500 that are in contract right now.
Wow.
So I think we'll hopefully exceed that. But we're very conservative. We're very we're very nitpicky with what we buy.
Yeah.
I mean, we want to buy very selective parks and very selective markets because we're long-term. We don't get in with the idea of exiting out in 3 to 5 years. I mean, we know they're not building them anymore, so we cherry pick the best. We want to be in markets that are basically expensive markets to live in because we're providing affordable housing, and there's a shortage of it there. And so we buy for long-term, and so we're very selective what we buy. We'll buy 100 this year. That's all that makes sense. We'll buy 1,000 if we can find 1,000 that makes sense.
Right.
So.
Awesome. So
Yeah.
I'm going to transition to Mark, because Mark, you had a similar story, I believe. You started in multifamily. Macy Dev was doing a lot of multifamily, but that's now all of your legacy stuff. You've transitioned your focus into office, medical, retail, and that's been since about the same time, 2008-ish?
Yeah.
So what's the story there? How did you transition into it, and why these assets? How'd you land on these?
Yeah, so we still own a lot of multifamily, like you said. We didn't sell most of it, but we stopped buying new stuff. I mean, I think the important thing to think about when you're thinking about an asset class or anything is it's a business, right? And sort of similar to what Dennis said is like, don't focus on like, oh, this deal or this thing. It's like it has to be a sustainable business model, right? Like I could find an amazing, commercial office building, one amazing commercial office building to buy in Denver, but if I never find another one, that's not a business, right? That's just one investment. And it's hard to build like a knowledge base like Kevin has or anyone else if you just do one deal, right? And then you do the next deal and something totally else you have no knowledge on. Like your first deal is always your worst deal in terms of, you don't know what you're doing, and so you just do it and cross your fingers and hope it works out. Sometimes you get lucky, sometimes you don't, right? But you learn a ton. And then, so for us, we were looking at the landscape and saying like, where's everybody going? And everybody was going to multifamily. And so we were like, I don't want to compete with everyone in this room and everyone else in the world. I don't want to do that. And so we went into a different direction, and we said like, people hate retail, people hate suburban office, like 'cause the internet is going to make it so everybody works from home on a computer and shops from home, and we never leave our homes like Wally World or Wally, right? I sit in those chairs and order everything. So we were like, all right, well, we don't think that's really true. Like, we think they're just like the single family home market, right? For a while, it was like no one's ever going to buy a home again. We're all going to rent. So we kind of went the opposite direction and said, like, okay, we can find some good value there. We can buy some good things. And we think we can do it for a while. It's not going to be like a 2-year thing. It'll be hopefully a cycle thing, so a 10-year thing. And that's how we made that transition. And some of it's the same kind of things that Kevin's talking about. I mean, we wanted something that was scalable, and for us, scalable meant nationwide, not in a specific market. And it's really hard to build a multifamily network across, we tried. Like, we bought a bunch of stuff in North Carolina and other markets that we weren't familiar with, and we just got burned every different way you could because we didn't have that operating structure that we do with our other multifamily portfolios.
Right. So I took two key takeaways from that. The first was you have to focus, otherwise you're just going to be a chicken with your head cut off, learning it's your first deal even when it's your 10th deal. And two, you want to focus, at least for you want to focus on an asset class that you can do truly nationwide so that you have the room to grow your operations.
Right, I wouldn't say that's for everybody. That's for us. Like our capital source wanted nationwide exposure because they're already heavily exposed in DC and New York. So they were like, we don't want any more DC, New York, even if you find a great deal. So for us, it had to be that. But for you, it could be just something that's sustainable. To me, it's a sustainable business model is the most important thing. So like, if he didn't think he could buy any more mobile home parks ever again, like he wouldn't keep looking at bad mobile home parks, he would look at something else, I would think, right? I mean, but it's like, the idea is there should be enough product type that you can build a sustainable business on it. And like a lot of people are just like, oh, well, there's a property across the street from the sale for me, so I'll just buy that. And it's like, think 3 years, 5 years, 10 years as the goal setting workshop, right? Because you want to have something that you can do for a while. You don't want to start and then start a new business. Like that's what we looked at.
Awesome. So, okay, let's drill into these specific assets, office, medical, retail. 19 out of 20 people raised their hand when they said they've done a deal before, but from my conversations, very few have purchased medical buildings before. What's the major difference between buying a medical asset, both the experience, the process of purchasing it, as well as owning it and the returns versus multifamily? Same question for office and retail, if you.
Yeah, I mean, it's about cycle. It's not really about property type, and it's also about specific deals, right? So we could find deals that have significantly worse returns that we would still buy than a multifamily deal for a lot of other reasons, right? So we may think, long term it has better upside potential, or it may have better credit, right? You're buying a multifamily building. It's all individuals, and they may have good credit rating, but they're not credit. They don't have like $100 million that they're at their disposal, and this is just one of their tiny locations. Where a lot of my tenants, they may be $1 billion company and they're renting a $10,000 a month space from me. I'm not that worried about them paying their rent, right? No matter what their credit score would be. They have a huge amount of assets. So we're dealing with a much more sophisticated tenant, and they require a lot more sophisticated sort of responses. So there's give and take. Like you'll get a lot of tenants that will beat the heck out of you. Like some of my worst tenants are like Starbucks and Lululemon and all these like big companies because they're like, we're a huge company and you're not, so we're gonna push you around, right? That never happens in a residential apartment. Like there's no one that walks in and says, I'm gonna, push you around and lower your rent. You're like, no, I just won't rent to you, like whatever. So there's that side, the sophistication side, but the sophistication side also has a benefit in the sense that I'm never getting a call like, oh, my toilet doesn't work and I didn't try a plunger because I don't even know what that is because I just got out of college and everything's always been taken care of for me. It's like when we had student housing and that was all the calls we were getting, right? It's like, so it's all relative to your annoyance. Like we're getting annoying questions like, we're gonna sue you because you didn't put up this sign that we asked you to put up. It's like, well, a student's not gonna do that, right? But so it's different types of problems, but also different types of benefits, right? We don't, we have 10-year leases in a lot of our properties. Like that's something I don't have to worry about unless they go bankrupt. That's a huge benefit. And that's true across both sectors, right? Like retail and medical office in some ways are very similar in that you're getting a lot more sophisticated tenants. I mean, you get mom and pops, you get like the one doctor office or the one nail salon that's, just opening that location. But for the most part, they're pretty sophisticated and they're making money and there's a lot less protections for them, right? If you're kicking somebody out of their house, the government wants to take care of them, make sure that you've done everything possible, depending on your market, like New York or Boston or wherever we own our properties, basically they have to murder your firstborn for you to be able to kick them out, right? Like that's it. Otherwise they're staying there forever. With a commercial office, if they don't pay their rent 1 month, I can lock the door, change the locks the next day, and that's it. They're done. Like there's nothing they can do about it. It's just we have a contract and that's it. And no law protects them.
Yeah, awesome. So I'm going to summarize some of the insights I heard from there. First being that the type of tenant is vastly different. And so the experience of acquiring these assets and managing them is just very different than a traditional residential. And secondly, the returns that you're looking for aren't necessarily about the immediate cash flow, but you're looking at qualities of the terms of the lease, like credit rating or if it's triple net, because that might increase the value of the property over time versus the traditional value add of increasing rents, let's say. Like there's other levers you can pull to increase value. Is that right?
Yeah, right. So like a really high rent property with 1 year left on the lease is almost worthless in today's market, whereas something that has a much lower rent but has a 10-year lease is like 5 times as valuable, right, or more, because people are valuing certainty in today's market. So a little bit of what you said is it depends on where we are in the market and what market you're in, but yes, generally speaking. So I mean, we do have properties that'll make 10, 12% cash-on-cash returns year one, and like, some of our multifamilies never produce that, right? So it's not necessarily like, oh, multifamily does this and retail and medical office does this. It's case by case, but there are a lot of other factors that but I mean, it's the same in multifamily, right? Like something you think you can increase the rents 20%, you may pay up for, versus something that's already peak of market or whatever. Right. So
awesome. Okay, transitioning to Scott. And now I wanted to talk to you last to start this off because I think your asset class is the most unique in that there are no tenants. That's a pretty big deal. A lot of people here have had to deal with tenants. They've had ups and downs with that. And you haven't dealt with tenants since 2005, right?
Yeah.
More or less.
My resting heart rate is probably lower than anybody's in this room.
So
first of all, good morning, everyone. Yeah. Good morning. Let's give a round of applause for Joe and Ben for putting on a great event.
Thanks, Scott. Thank you. Thanks, guys.
What was the question?
So Scott, everyone's talking about self-storage. I mean, this is like self-storage is the multifamily of 3 years ago. Like self-storage is where everyone wants to be spending their time because they've heard about tenants, they've heard about you, they've heard about this awesome asset class. Are we at a market peak? Are we approaching a market peak? Is it going to be saturated in a year or two? Where are we in the market cycle? How can you make money with self-storage?
Yep, no more opportunities.
Stop looking.
I'm getting coaching from over here. Now, as a matter of fact, when we went through this recession at the beginning, what happens when we start the recession is that the commercial lenders, they shut the faucet off. On development of all sorts, because what they're lending on is historical cash flows. And if you've got a piece of dirt and you say, I'm going to put this cash flow on it, well, that's not going to pay the payment that comes due from the loan in 30 days or 60 days. So a lot of that goes away. So as a result of that, we have a huge demand for self-storage during a recession, but there was hardly anything being developed. And so during good times, what do we do in this country to celebrate the good times? We buy more stuff, right? And so we ran out of room, we put it in storage. So storage continues to go up and to the right, but then what happens during a recession? We downsize, and we move back in with our parents and our friends, and we have to store more stuff. So self-storage actually faces a boom time during a recession. And so we had a lack of development dollars and development and an increase in demand. And so for the past several years, there's been an undersupply. Virtually every major, every top 50 MSA is facing almost 100% occupancy with waiting lists at most of their facilities. And so I attend and speak at the inside self-storage trade shows, the industry trade shows, and last bet, kind of a round number, is about somewhere between $20 to $25 billion in development as a deficit, that we need to meet the demand for self-storage right now. So we're still trying to catch up to that, and
That's crazy, by the way. So we're talking like
crazy.
several years out before we're anywhere close to market
2020 to
saturation.
2021 are kind of the estimates in which we feel that we're going to reach market equilibrium where supply meets demand. And so if that's any indication, yeah, we think we're obviously pretty bullish on self-storage right now.
And if I remember from our pre-call for this conversation, you said 2021 would match what we saw around 2005 when you bought your first self-storage
Correct.
unit, which cash flowed how much right off the bat?
$10,700 per month, but who's counting?
So market saturation, we're still looking at extreme profitability.
Yeah.
All right.
Yeah, just like everybody else mentioned, you got to buy it right, which is finding the right deal. Yeah.
Awesome. Okay, so both Dennis and Scott, because you guys are both in kind of the development world or getting there. How does city regulations play into these asset classes? How does does the city play a part? Do you have to be an urban planner? What skills do you have to work in self-storage or assisted living? Because a lot of this stuff requires conversions or ground-up development. Who do you need to be? If you're not just trying to buy an existing operating asset that's already doing its thing, you want to be a little bit riskier, possibly a little bit more return. What part does the city play, and who do you have to be? What skills do you have to interact with them? Yeah, either of you guys.
The thing about assisted living is that cities, states, all the government entities want you. Nobody wants to fight you because senior citizens are a major voting class, number one. We are at the front end of the baby boomer generation, which if we talk about what is the going forward opportunity, that's a big topic. So there's massive demand. We just put an offer in on a piece of land. Prior to putting the offer in, we went and talked to the city. They could not wait to schedule a meeting with us because it's been a topic in their city council. The city where I live just had a big article in the paper about somebody who wants to develop an assisted living environment, and they are hot to get it done. So because of what you're bringing to the community, you don't get a lot of pushback. You get very little pushback. The only thing that you have to have, and it's really not that difficult, is you obviously have to meet certain requirements for safety, fire sprinkler systems, evacuation routes, things like that to get people out of the building, handicapped people out of the building effectively in an emergency. But that's just all in design, and even if you're retrofitting a building, which I'm always looking out of the box for existing commercial buildings that could be retrofitted, you can get sprinkler systems in there. The biggest thing for me is bathrooms. I'm looking for plumbing because I can do everything else so long as I can put enough bathrooms in there. So, but as far as, who do you have to be and what do you have to know, it isn't that hard because there's such a need for it that most jurisdictions will pave the way and help you get it done.
So knowing what the township needs is much more important about who you are, or
yes, absolutely.
cronyism, or
because it's like anything else. You can tap into the expertise to support yourself. It's really about finding the right piece of land and coming up with the right design. But the city is not going to stand in your way. Anybody who's ever built anything, working with a building department and inspection department, they make me crazy. They'll make anybody crazy. Those who can't inspect, that's my rule. So, so you get a lot of pushback on that kind of stuff in most things that you build. While you still have to go through inspections and so forth, you don't get a lot of fighting because they want to see you succeed.
Awesome. And Scott, you're also, or your crew of people that are converting around the country, are converting bowling alleys into self-storage and warehouses. Do you have to work with the city to get this approved?
We do. We got a little tougher road to hoe in many cases than Dennis does. Just about all of these, the cities, they want assisted living, they want apartments, they want to hang their hat on that, and they'd like to see every old building turned into apartments, and in some cases low income, so they can put a feather in their cap and have some other private developer do that. When all reality is self-storage needs to be a part of their master plan, and the buildings and the land that we're looking at usually have been picked over by the assisted living folks, the apartments. They just don't work, and so we're doing our best to buy those and convert those and then convince them and educate them on the need for self-storage, but also really taking the approach of, hey, if it's a pretty hot market now for apartments and assisted living and everything else. If they wanted to buy that building and convert it, why has it been sitting on the market dark for 4 years? This is the highest and best use for this, and we have the feasibility studies to show that. And so we have a little more of an uphill battle and a little more education. Also, when self-storage is built out, we're buying these shells for pennies on the dollar, and then when we build it, we're putting up walls and doors for 10, 11 bucks a square foot. So when the final product is done, from an assessed value standpoint, it's considerably less than almost any other asset class, and therefore lower property taxes. And so they're not always bullish on it. So our approach is we want the crud, we want the ugly stuff that nobody else wanted, and then we'll come in and reuse it and put it back on the tax roll for them. But as far as go ahead.
What do you need to bring to the table for the city to say yes?
So, a whole lot of humility for one. And, just a well-thought-out plan, knowing who the players are, creating those relationships, and, everything from renderings to 3D models, incorporating colors, the history of the buildings if we can, and, to kind of tug at some of their heartstrings. But at the end of the day, we know that we can only get so far usually. So we'll bring in a land use attorney who can really tell the exact same story that we're telling and the reasons why self-storage is needed here, because it's undersupplied and people have their stuff all over the place, and it clutters up the community, and it has low traffic, and this is the best use for this building, and if you want to get back on the tax rolls, all the things that we say, but coming from a land use attorney's viewpoint, so that we can sit back and let him do his work, and usually picking one that has a relationship with the city, the county, the zoning board, to get things done. That's who we bring in.
Awesome. Okay, so switching gears a little bit. A couple of folks, when I talked to them on the phone, wanted to know about asset protection. So I want to ask you, Kevin, and you, Scott, as well, because you both mentioned, when we're in an uptime, there's a greater need for self-storage, and when we're in a recession, people downsize. Perhaps you don't have the 100% occupancy that you did before, and we've got a diminishing asset class here. So how do you build this empire that you're building, build this portfolio while simultaneously protecting against a market correction that could be even a fraction of what 2008 was?
Yeah. So the good thing about mobile home parks is they're somewhat recession-proof. I say it this way. If you can't afford to live in an A-class apartment building, you move to a B class. Can't afford to live in a B class, you move to a C class. You can't afford to live in a C class, D class is war zone, right? You got to pack heat to go collect rent, not a good place to be. But your other option is to live in a mobile home park, which is much safer than any D class, probably equivalent to any C class, apartment building out there, and about half the price. So if you can't afford to live in a mobile home park, you're underneath the bridge or you're homeless. There's really no other option. So recession-proof, I really don't know any other housing type that is more recession-proof than mobile home parks.
It's an inferior good in a recessionary market.
Absolutely.
What about in good times? You don't see people bail out to go to somewhere else?
We have that happen. It's going to happen, but at the end of the day, there's a massive shortage of affordable housing in the United States.
So not much
and no
for
one's
them.
meeting that demand.
Yep.
And so although people do move up, people get into a mobile home, maybe it's like their first step to a stick-built home ownership. But there's plenty other people waiting to come in and take over that affordable spot that is left.
Makes sense.
Yep. Again, a lot of it's market selection. We make sure that we buy in markets that are not affordable to live in, and from a affordable housing standpoint. And so we always have a demand. We buy in good school districts. We buy in good areas that are close to shopping, close to retail. So there's always a very high demand for our product.
That's
So
great.
it's not a problem. As far as how do I protect ourselves, or how do we protect ourselves regarding the diminishing supply and not being built anymore? No one knows the exact number. There's about 55 or 60,000 mobile home parks in the United States, and
That many? Wow.
Well, let me classify a little more. So anything more than one mobile home on a piece of land is a mobile home park. So
I see.
So it's kind of a misleading number. But the good thing is it's a very fragmented industry still, probably very similar to what self-storage was. Probably self-storage still has that same component to where there's a lot of mom and pops. Back when self-storage originated, tons of mom and pop. It was a mom and pop business. Mobile home parks kind of the same thing. And so there's a majority of parks still in the U.S., more than 50% are still owned by mom and pops. And so, and the good thing about that is they're an aging population. And most of the parks that we buy or that we go after have been owned for 20, 25, 30 years. They're in their 60s, 70s, sometimes 80s. And so there's a lot of those opportunities left out there. Now, in 30 years, are there going to be? There's probably going to be a lot more guys like me that have bought those up, professional operators, institutional guys. I mean, we do have that kind of competition, which will be less likely for us to find a great deal like we've been finding today. And so, but I think we still have a good 10, 15-year run. And at the end of the day, even if a professional buys a spot, like a mobile home park, doesn't mean they're going to run it right. There's still, just because you think you know what you're doing doesn't mean that you do. So there's still going to be opportunity, I think, even when...
I'm sure that's the same across the board.
Yeah, once it actually becomes less defragmented, there still will be opportunities out there for mismanagement, just like you guys experience in the multifamily space. You always look for those places, those multifamily properties that are mismanaged, they've been run properly, have been advertised properly. They become the redhead stepchild, even if it's a big owner. And I think those opportunities will still exist down the road for mobile home parks.
All right, that's a fair answer. So Scott, same question, because you brought this up about the number of units and demand go up and down through market cycles. So how are you protecting against an inflection point in the market cycle?
Yeah, Yeah, we are in that luxurious position of being in a very sought-after asset class when a recession hits. There's only one other industry that benefits more during a recession than self-storage. Any guesses? Alcohol.
Yeah.
Mobile home parks.
Yeah.
Who got that? Was that Omar?
It's alcohol. What are you going to do? I give up. I'm just going to go drink all these problems away. So in a recession, alcohol is the top industry. Self-storage is number 2 because of all the consolidation. So how are we protecting against that? Personally, we're doing the same things that we're doing right now, except faster. We're preparing for that. The first recession back in '99, I was a victim of that. In 2008, I came out about even, so I don't know what you want to call that, but we are going to be a participant in this one because we know what's going to happen. It's happened at every economic cycle in the past that we've had. That happens every 7 years. Self-storage is in high demand, and the money goes away. And so we're syndicating and gathering all types of investors, and then putting together as many development opportunities in existing facilities to make hay while the sun is shining. And right now it's doing well. We still have a huge deficit, but then when the recession hits, we'll have even less competition because those folks that just rely on the banks those developers and those owner-operators will go away. The adjustable rate mortgages will come due on the ones that those folks are buying right now, and they may be over-leveraged and not running them properly, as we just mentioned. And so we'll take advantage of that, and we won't have to darken the door of the banks because we'll just take them down with our investors.
Awesome. So you're just like waiting with a bunch of money like a cobra, waiting for the right time to strike. Awesome. All right, so Mark, what is a triple net lease and why is it awesome?
Okay, great. It's essentially a carefree lease is what they call it a lot of times. As with everything in real estate or investment finance, in my experience, like you can call something 50 different things and it's the same thing. So triple net can mean that you do actually pay some expenses, but at its like core level, it'll basically mean the tenant pays everything and you just collect rent. So if somebody says, I'm going to pay you $10,000 a month, it's not $10,000 minus all these expenses, it's $10,000 and they're paying the electric, they're paying the taxes, they're paying the repair of the building, the HVAC. So it's very just carefree, easy to understand, easy to underwrite.
Okay, awesome. Switching gears. This is my last question before we go down the line on some like rapid fire stuff. Everyone else has kind of mentioned a little bit about what they look for when they're acquiring. You're looking at almost every MSA around the country, or is it east of the Mississippi, or is it the whole country?
Yeah.
So what are you looking for when you're looking for office, medical, retail, as far as what to pinpoint qualitatively to acquire an asset?
Yeah, I think it's the things everybody either is or should be looking for in a market. You want growing or at least not shrinking demographics, so you don't want people in droves moving away. They don't necessarily have to be in our markets. They don't have to be growing hand over fist, and a lot of times we don't want that because once something's real obvious like that, like if it's a super boom market, then everyone's there and it's super competitive and people overpay because they're over optimistic. Oh, this 20% a year growth is going to continue forever and this is going to be the biggest city in the world and crazy stuff. So we try to stay away from those extremes, but certainly stable and sort of generally increasing. Educational institutions in the area is a huge plus. So colleges, universities, even community colleges, things like that, where people can better their lives and kind of stay in the community if that's what they want to do. diverse employment base. So again, not one kind of, if it's oil and gas city and oil and gas dries up, you're screwed, right? So stay away from like the sole source. And kind of looking at just sort of the general populace and saying like, is it kind of going in a direction that follows the trends of the overall market, or is it kind of going opposite in terms of, education-based, job-based, things like that? Is the city kind of, trying to do things that make sense? Like, are they supportive of logical projects, or are they kind of poo-pooing everything? And honestly, I'd look at like San Francisco and say they're doing the opposite, right? Like they're killing affordable housing, or they say they're good for affordable housing, but they're actually limiting everything. And you see what happens. It's like an overpriced market you can't afford to live in and make a reasonable salary.
Yeah.
We don't want that. We want normal people to be able to live there, that they don't have to make $1 million a year to afford to shop or live or whatever. That's kind of what we're looking at.
Okay, awesome. All right, so Mark and Steve, can we get handheld mics ready for questions? While that's going on, I want to ask you guys a question, and I hope it's not like a one-upmanship question. You guys try to like outdo each other. And I understand there's caveats.
Can I go last?
No, yeah, he wants exactly.
So starting with Kevin, going down the line, what are the returns you're looking for? When you're looking for an asset, I understand that there's different risk levels that we're talking about here, so not all returns are created equally, but what are the returns you're looking for? What's your cash on cash, your IRR?
Yeah, number one, we don't really look at IRRs too much because we don't want to expect a liquidity event. We want to know real numbers today, like what's our money really doing for us. So we really like to, and I'm not saying we do it all the time, but our target within the first 12 months is know that we can achieve 18% cash on cash returns on our properties, and know that we can accelerate it past 20% after whatever value add component we put into place.
Wow, leveraged or unleveraged?
Yeah, leverage, absolutely leveraged.
Okay, so the right financing is key.
Yeah, I mean, normal financing, 70, 75% LTV type stuff.
Okay, all right. What's the number if it's unleveraged? Do you know offhand?
We don't even shop on cap rates. I think it's irrelevant. But I mean, I guess if you had a look at our portfolio, we'd probably buy on average at like 9 and 10 caps, something like that. But
Okay.
again, but it's irrelevant because a lot of stuff we buy is a stress, and so there's some kind of component of it that's not working correctly. For example, one of our best operating properties, if you looked at it from like an unleveraged standpoint, we bought it at a 4 cap, which makes no sense whatsoever. But within like 3 months of fixing the broken parts, is effective like a 15 cap.
Right. Yeah.
So,
So less interested in the cap rates that's being sold at,
Yeah.
more interested in what you can cash flow in 12 months down the road.
Absolutely.
So Mark, same question.
Yeah, I mean, we go the 100% opposite end, right? Like we're buying mostly stable stuff. Like we want bulletproof cash flow. So the last thing I want is to buy something today, promise people it's going to be 20%, and then have it be 2%, and everybody freaks out. So most of what we buy is operating, occupancy's high, leases are long. Our risk is extremely low, short of major bankruptcies or crazy things that we don't anticipate. So we're really on a cash-on-cash basis, somewhere in the 7 to 10 range. Really these days more in the 7 to 7, 8 range, just because things are really competitive.
Right.
But again, and that's levered, and it's cash-on-cash. True return. Our total return will be somewhere in the 10 to 12 range. IRR, same thing. I mean, I literally don't look at it because we don't. Yeah, I don't know. You tell me what cap rate you want. I can tell you what what IRR you're going to get, or vice versa. You tell me you want a 20, great. It's a 20 now. Because you can make it up. But but that's kind of the cash driven.
Dennis, I know yours is different because you're also the operator, not just the real estate owner. But what are you looking for?
Yeah, and we're looking to hold properties, not put them back out there on the market, at least in the short run. Operating, though, our number is about 23 to 26 is what kind of return we're looking for.
Cash on cash or EBITDA to revenue?
To revenue.
Okay, yeah. So Dennis is talking more about the operations side of things. So he's
Right.
talking about the percentage of profit over revenue versus the returns from purchasing the asset.
Right.
But that's still a solid margin for a business. Okay, cool. Scott, same question.
Kind of a combination of all the above. I mean, we look at our deals in terms of what's going to attract the most private equity and still provide a return that we're happy with when the project is done. So pretty much all of our projects are anywhere from 3 to 5 years. There's going to be a hard stop at 3 or 5 years. And in that time frame for our investors, we want them an internal rate of return somewhere north of 20% if possible. And then on the back end to them is usually 2.5x times their investment. And for us, we manage to that. We're trying to be a little bit better than anybody else to attract the dollars and look to see what's out on CrowdStreet, Fundrise, Realty Mogul. Sorry if anybody in the room is from there, but be competitive with them and attract those dollars.
Right.
And so that the ratios, the splits could be 70-30, they could be 30-70, depending. We just want to be competitive in the marketplace, and then our returns on the back end are considerably higher than what we're offering to our investors, obviously.
So let me ask the question in a slightly different way. If I'm going to go and buy a self-storage unit and I want to copy your model and I'm going to put
Yeah.
all my money in and I'm not going to syndicate, what cash on cash should I be looking for? If I'm going to copy you, which is impossible, but in an ideal world.
Gosh, yeah, we really don't look at it in terms of cash on cash, but I'm
No.
looking at that point, we're really looking for about a 4 or 5x.
Over how many years?
Yeah, usually 3 years is when we can get
Okay.
something stabilized. I mean,
Well, in
it's the
development,
same
you would-
thing.
Right, in development. You're
0%
liquidating.
cap rates,
Yeah.
development. So, we buy stuff for $3 per square foot, and
Wow.
then we turn around and sell it for 50 once we put an income stream on it. So it just
Yeah.
depends. We're buying these old shells, these old industrial buildings that nobody wants. So I don't want to say it's not fair, but all these projects are really different from what we do, whether it's dirt or something that we're converting or an existing. They're just,
Yeah.
it varies. For our investors, we manage to the market what'll get the most for us, and then if it's a screaming deal, we'll obviously make more than, there is no average deal, is what I'm saying.
Right,
for
right,
us.
right. So we're talking about development to stability versus
Yeah.
buying something
Yeah.
that's already
All
stable.
value add,
or
extreme value add is what
value
we're looking
add,
for.
yeah. Okay, awesome. All right, so we've got 20 minutes. Mark and Steve are going to be passing out questions. So if you have a question, raise your hand, and they will selectively choose who to give it towards. And Steve, do we have a second mic that we can? No. Okay. Thought I saw one earlier. Hey, Steve, let's grab this extra guy right here on the corner, and we can set up the next question. It's right on the corner of the stage. Or there.
It's wired.
Oh, it's wired? Never mind. Okay, go ahead. Allison.
Okay, do I need to say who my question is for?
If you'd like.
Okay. Well, I own 3 of the 4 asset classes on stage. This was very hard to choose, but sorry, Dennis. My question's for you. For when operating ALRs in mid to lower income areas in Colorado, do you do semi-private or double occupancy rooms? Or is it true that this model can no longer be used in Denver because of the market demand for private rooms?
The low-income assisted living environment has a massive demand, well beyond its supply. My current property is 32 beds, and I maintain 30 people on my waiting list. I turn people away constantly. And this all depends on your state, because while housing for assisted living is paid through Medicaid, it is funded by the federal government, it is managed and distributed by the state. And the state determines what the rate is. And in the state of Colorado, the rate is very low. So it's all about buying the property right and having a viable overhead. Now, directly to answer your question, in my particular facility now, in order to be on Medicaid, and I do private pay as well, but to be on Medicaid, it is a shared room. But it is my desire to move away from that, to provide, and believe me, nobody cares that's moving in. They're happy to be there because their choices are so limited, and our place is pretty nice. So there's never a pushback on that. But out of a dignity thing, we'd like everybody to have their own room, and so that's the direction we're going. However, I can tell you that there is no way to run a low-income assisted living environment on market dollars, okay? I am in the process of developing one, but it's going to be developed through federal tax credits. You can make it work. You can make it work well. They're hard to get. They're very competitive. They're very difficult to get. But the demand for low-income assisted living is so out of control right now, and it's only going to get bigger. The baby boomer market doesn't even begin to have the money they thought they'd have to carry them through the end of life. They don't have the money, and they're living longer. The demand it's insane.
So even without Medicaid, you would say that you could still do a double occupancy room with Medicaid-like rates for private pay?
Yes.
Okay.
You can't, because I do take private pay in shared rooms, because it's half, it's a little more than half of my private rate. And again, the other thing is there's a chasm of people that fall through the cracks. They make more money on their pensions and Social Security they don't qualify for Medicaid because they make too much money, but they can't even begin to think about getting into a market rate facility. So those people flock to my door because they can take a shared room at a private rate for half what anybody else is going to charge them.
Very good point. Thank you.
Next question.
This one also is for Dennis. On the economies of scale, what size properties do you feel is probably optimum for the business?
Okay, again, I mentioned earlier that different states allow different things. I don't know this for a fact. I have been told that when you get to the East Coast, they've never even heard of residential 8-bed assisted livings, and they're everywhere in Colorado, okay? So it's a different market here, and so those are people who take a residential home next door to your home, and they, by right of use, can put 8 residents in there and be licensed by the state. They still have to meet the requirements of sprinkler systems and all those other things, and the neighbors, well, but they can do it by right of use. You know, the neighbors really can't push it back too much. But to answer your question, I started out that way. It's a way to get into the business. Everybody in Colorado wants to do that. I have people call me every day. I am not, I would never go back there, and I don't encourage people to go there. When you have 8 people paying, and now I know a bunch of people that are doing it successfully, very successfully, but you've got to be in about the $4,500 a month range, and you have to keep your rooms filled. The other thing is it's hard to get a residential home where you can have 8 private rooms. Mm-hmm. And when you're charging $4,500 a month, nobody wants to be sharing a room for $4,500 a month. Yeah. And everybody shares a bathroom. So you have all these things that come into play. I personally would not encourage anybody to touch anything with less than 10 beds. 12 would be my minimum, but in my current operation and all of my future development plans right now, it's 16 beds. And 16 beds is my magic number for several reasons. When you talk about requirements for staff to resident ratios, that is a magic number, believe it or not, for overnight coverage. Okay? I don't have to have extra people on staff when nobody's doing anything, because the residents are all sleeping. I mean, we have our staff doing things. We do laundry at night, we do cleaning at night, things like that, but there isn't any heavy needs for care and so forth. And with 16 people, I can limit the number of payroll dollars I'm spending. And remember, 24 hours a day, 7 days a week. Payroll is the number 1 expense in assisted living.
All right, awesome. Thank you, Dennis. Next question. Dan in the front here, Mark.
When raising money, I guess I'll toss it up to anybody but Dennis.
Or Dennis.
When raising money and syndicating a deal, do you guys look to get your investors a preferred rate of return, or do you bring them into the deal to take 25% equity and they could make 70% return, or that 25% could get them a 10% return on their money?
Both.
Yeah, both.
Yeah, we start with preferred return, something again that is attractive enough to get them in and give them. And the reason for preferred return to begin with is letting them know that they're going to get paid first before we do. So that is kind of a good faith, if you will, effort. And now it's become the norm, and you'll just see that as a part of all equity raises. We don't do any debt financing, meaning we're not just going to offer them, you know, what you said is a preferred return, but basically just a rate of return, like a hard money lender or a debt lender, without any equity. It's a very, very competitive landscape right now, and it's tough to find folks that would lend to you and not have a piece of the deal. And so we start with a 8% preferred return. It could go upwards to 12, depending upon the project. And most of our equity raises are the splits, the ratio are somewhere between 40 and 60. And again, that could be 40 to us, 60 to them, 60 to us, 40 to them. Again, we're managing to that internal rate of return, if you will, and then putting together a really strong preferred return to make it attractive for them. So then, yeah, on the back end, they're also going to get a kicker. And for us, and we're converting and developing, so there's going to be a big kicker on the back end so that that return pops up in year 3 or 5 when we sell. And so their overall return could be well north of 100%.
I'd say, just real quick on an aside, I mean, just a counterpoint to that, it depends on the type of deal. If you're talking about development deals, like I think what he's saying is completely on par. I mean, we don't do development deals anymore, and so you can come up with any structure you want and can sell, and it also depends on who your investor's base is. You know, like, a lot of times we get investors that are families or whatever, like very wealthy families, and they have never dealt outside the family. So you start talking about IRR lookbacks and all kinds of crazy finance structures, and they're going to be like, I don't know what the heck you're talking about, and so I'm just not going to invest. So it also depends on your investor base. Like if they're your friends and family, you probably don't need to go that route because it might scare them off, truthfully. Even though it is better for them, a lot of times we find people argue against it because they don't understand it. In the institutional world or the larger, development world, you're going to need to go exactly the route he's talking about. I'd say that the other point that I want to make on that aspect of it is be careful with the, if you're talking about protecting your downside, which I think, y'all need to be thinking about and we think about every day, is what does that really mean? A preferred return essentially means you're working for free unless the asset performs at a certain level. That's fine if your asset class is short hold and and the market's doing great. If the market doesn't do well, and we've saw this in 2008, it's like you're working harder than you've ever worked in your life, and you're getting paid nothing because you haven't hit that hurdle, right? Because it's a problem asset now. And so I think you need to think through that structure a little bit and sort of worry about what does that really mean? Because the last thing you're going to want to do is be completely disincentivized to work out an asset that's not performing, because that's going to be your biggest marketing point on the way out of the downturn, right? Is that you turned around this thing that nobody thought they could. Well, if you're not getting paid for that, you're going to need to get another job or something because you can't work for free forever, And I think that's something a lot of people don't talk about or think about, but it's really important.
I was there. That is important. Okay.
Just one. Check.
Yeah.
All right. One follow-up to that. If you have an asset that is performing and you're going to have a value add component, say it's a 3-year hold, is there a kind of IRR figure that you're looking to get your investors to make? Scott, you had mentioned you might structure it 40-60 or 60-40, depending on the take. Is there a kind of magic number that you look for your investor to make with the combination of preferred return plus the exit equity, where maybe each year for that 3-year period they might make 20%, or could you squeeze it down a little bit where you might take 70% and they're going to get 30, and their return would be kind of 15% per year based on what else they could get in the stock market, or kind of controlling the investment that way where you're giving them kind of 15% per year?
Well, I could answer that a number of ways. And, we have different pools of investors when we put these deals in front of folks, and some of them want to have cash flow. And so for that, if it's a deal that we know that we can turn around and or get cash flowing in a short amount of time, then it's going to be a safer investment, something where they have cash flow up front and better than the stock market or what they're returning. So it's going to have a lower, probably below 20% internal rate of return, and it'll still have a kicker on the back end, because that's all we do is the value add components. But then we've also got a lot of projects that we do where we attract investors who don't care. They don't need the cash flow. They're investing in their self-directed IRAs or real estate 401k. And they want, what may work out to be a north of 20% internal rate of return. It's going to be negative, in the first maybe 1, 2, or 3 years until we turn that thing around. But it's made up on the back end, and then that's when they get a 2.5x return on their capital. So their total return, which if you're managing into a 20% internal rate over 5 years, is 100. Well, we're north of that. We're 150, 160, 200% total return if you look at it from an IRR standpoint. But then, as we mentioned, it's not really an internal rate of return if we're looking at the time value of money if nothing is returned at that point. So then we just make it simple. It's just hey, how much money are you going to get back at the end of this thing? And you attract more people from that standpoint. So there's a number of ways of raising, private capital. It's an art,
Yeah.
It's knowing, who your folks are, talking to as many people as possible, and then in those conversations, in the beginning, at least if you can find that out, or discern from some portal on your site, are you looking for cash flow, or are you looking for big pops on the back end? If it's less risky, then they're satisfied with this. If they're willing to let it ride and get the bigger kick on the back end, that's great. when you're looking at the splits, then the same thing is, you know what? If you're having a tough time selling something that's an old industrial building that you're buying for $500,000, but you're going to sell it for $3 million in 5 years, you're probably going to have to offer up a little bit more than a turnkey deal where somebody knows predictable what they're going to get, you know, month in, month out, year in, year out, you know, with a certain degree of certainty, if that makes sense. Did I confuse you more? Okay.
And I want to add a point to that. I think what you really need to do is you have to understand who your investor base is and what their expectations are. Because we could throw out 20 different structures of how we've done deals in the past, but if you don't know who your investor is and what their expectations are, then it doesn't really matter. So you really need to build your structure of whatever investment you're looking to syndicate for around what your investors' expectations are. For us, we know that we have a certain investor base that they're expecting a certain type of return. And so we base our equity splits and our preferred returns so that we can achieve that based on the typical assets that we buy. And so we kind of back into the number of what the split's going to be, the equity split and preferred return we have to pay to comfortably hit that. And so that's how we figure out what our structure is going to be. So you just have to understand who that investor is. Our investors, they expect more. They want 14, 15% return on their money. You know, other investors, might want more than that. They might okay with less than that. They want a more stable asset. They want to work with Mark because he's buying these stable assets with brand new 10-year leases in place, and to them that's less risk than, you know, a turnaround mobile home park. So I think you just have to really understand who your investor base is. And
But it's also spectrum of risk, right? So like if you are an investor in the stock market, you probably also have some bonds, you probably also have some cash, you probably also have all. So it's similar here. Like I'm sure some of the investors that invest in our deal invest in their deals or deals just like that, because not everybody wants 7% returns, but also not everybody wants to swing for the fences and possibly strike out with their whole portfolio, right? Because there is a risk spectrum to the other side of that. Like we haven't seen it in the last 6 or 7 years, but it exists. It will happen, right? There will be a 2008 reckoning that happens again. So it's also about the balance of that. And if you're looking for like a down the middle all day number, I mean, basically just look at what your alternative investments are and try to be a little higher, and you'll sell that all day long to people who don't know any better. So if it's your first deal and you're saying, I don't know what to do, and you guys have talked to lots of investors, so you know, it's like, there's no commonality, but you know, 3-year return, 15% IRR, that's like the average that everybody shoots for, like mid-teens return. That's what everybody wants. That's like the buzzword of our industry. I think it's BS, for lack of a better way to put it, but it's, if you want like an all-day answer, that's your all-day answer, you know.
I'll tell you the quickest way that we've raised money is in the recent, we do this via webinar for the most part. We just take the IRRs off.
Yeah, it's
I
good.
find that because the confused mind says no. I think Kevin
Yeah.
or Mark, somebody mentioned, and so we're just taking that off and we're just showing in simple terms. You invest 50,000. Here's what we're going to give you back. You know, our projections.
Yeah. I think
They
that's
can do
good.
their own calculations.
One or two more? Anyone over here? Let's do Neil over here, and then we'll get to, I haven't met you yet, but we'll get to you.
This is a question for Kevin. Dennis, you mentioned, Dennis mentioned the demographic pressures that are sort of causing assisted living to boom, which is the retirees retiring with not enough income. Are you seeing a similar pressure or growth in mobile home parks because of that as well?
Yeah, you know, there's different types of mobile home parks. I do see that we don't own any senior parks, so there's 55 plus age restricted parks, and then there's, you know, we call them all ages parks, which are just families of all ages. I mean, you don't have to be a certain age to live there. And so I'd say that I wouldn't say we're seeing a direct pressure, direct impact like to the positive because of that, but I guarantee that the 55 plus communities probably are. You know, so.
And the same with our medical too. I mean, that's part of the demographic trend that we're following. We invest in medical. We want an aging population because aging people that living longer, spending more in medical. I'm assuming similar to.
Yeah. Yeah, we're actually in contract on a park right now in Ocala, and it's a
I love that market.
it's an RV park, but in Florida that means something different in a lot of places because actually half the units are permanent. They're park model homes, which are basically what they call tiny houses now in the hipster world. But actually, park models were like around for like the last 15, 20 years. They're just tiny one-bedroom units, and that park there, it's an RV park, and it's not age restricted, but it's majority 55 plus crowd, although it's not an age restricted park. And that one there's a huge demand in that Ocala market for, it's like, I call it like blue collar retirement living is what it is. So with that park, we're going to convert the remaining RV spaces that are transient, you know, pull-ins and, you know, just, you know, come and go type people to more permanent. We're going to bring in these park model homes because there is a huge demand from the baby boomers that need affordable either second homes or they're just selling their stick built home and they're downsizing and they're getting something more manageable. So there's a huge demand for it. And in fact, the person we're buying it from, they've already converted, I think about 30, they brought in about 30 homes over the past year and a half, and they've sold them like that. So there's a huge demand for it.
Awesome. Last question.
Yeah, a question for Kevin. For a new investor in mobile home parks, is there a minimum that you would say, okay, start with this? And a second follow-up to that is, are you not developing any new parks, like just put the plumbing lines in there and create new pads? And
I'll
is that
answer
because municipalities are against it? And
Yeah, so that's a big component. So even if you could get the municipalities on board, the cost of putting the infrastructure in typically doesn't it doesn't make dollars and cents. I mean, to put the roads and put the water and sewer lines in, you can just go buy parks nowadays for under replacement cost. And so there's no point in building if you can just go buy one that's already existing and in place and don't have to go through the development stage. But also, even if you could make the numbers work from a development standpoint, so now you've got a huge amount of debt out there on a parking lot, essentially, that you've got to basically create revenue from. And so you're at a point in time to where you're waiting for people to move their homes in, which isn't a common part of the business anymore. Typically, being park owners, we've got to bring homes in order to create that revenue. We've got to bring them in and sell them. Back when parks were initially developed, it was kind of like, build it and they will come. That was the business model. You got a piece of land, this farmland, it's great, let's put some roads in. And there was tons of lenders out there that would lend on mobile homes, and so people would move them in droves. And these landowners were like, this is phenomenal. It doesn't work that way anymore. So to develop something just doesn't make dollars and cents. And the other question was about the size, the typical size. We see that, and there's some variances there because every market's different, but our typical size that we see that we get really start seeing some scales of economy and can afford like quality on-site management, because every park we own has an on-site management, either individual or a team, is about 40 spaces. With that being said, we do own one park that's smaller than that. We own a 35-space park, but it's in Atlanta, and the lot rents are extremely high. They're probably the highest, I think they're the second highest of our entire portfolio. So that park produces as much revenue as some parks that we have that are 50 and 60 spaces because the lot rents are so high. So, but I'd say like 30 and 40, it's kind of like the rule of thumb that we go after, that I would suggest if you're looking to get into the business, look for that number, because you don't want to manage these things yourself. You just don't. You want to be able to afford to have that on-site manager in place. And in most markets of the country, you can get there with like a 40-space park. That makes your numbers very comfortable. You can run it like a professional. You don't have to go fix toilets and plumbing leaks and things like that.
Very good question. I like that question. Yeah. All right, so 90 seconds or less for each of you. It's my last question. Best ever advice to be successful in your asset class in 2017?
Okay, I'll start.
Yeah.
All right. I think, so my asset class, right? I'm going to speak in generalities for a second. I think that, and this works for me, and it might not work for others, but I think that first off, you just got to focus. You got to figure out what asset class it is. Maybe it's mobile home parks, maybe it's medical office, maybe it's self-storage, but figure out first and foremost what asset class you want to focus in. And it might change down the road, it might change 5 years from now, but figure it out right now, focus on it, and spend the time, spend the energy to learn everything you can about and become the expert in it. And don't stop until you do a deal. Like literally, just stay focused. Know it's going to be hard, know it's going to be challenging, know you're going to hit roadblocks, you're going to have all kinds of issues that pop up. But stay focused and pick that one asset class and just run with it. I mean, that would be my best advice. I see people that chase that shiny object syndrome, and I have the same problem. I still do, even though I know it's a
Dogs
challenge.
chasing squirrels.
Yeah, but just focus. There's 1,001 different ways to make money in real estate. Pick one and just run with it. Focus on it until you make money at it.
That seems to be a theme. Focus. Okay, yeah. Mark.
Yeah, for medical, the trend is moving towards the community base. So, people don't want to drive to downtown or wherever it is that they, if they live in the suburbs. So from that angle, I'd focus on sort of like the most hated asset class in the industry, whether you know it or not, is suburban office, and find like some easy access suburban office that's sort of bite-sized but near a lot of homes. That's going to be a very demanded space long-term in the medical space, because they want to be, old people don't like to drive real far to go to their doctors. So that would be a good avenue there. And on the retail side, retail, the focus of ours has been like a multi-use, right? So today it's a bookstore, but bookstores are going away. But tomorrow it could be the Amazon grocery store or whatever. There's new trends all the time, and you're taking advantage of those new trends. So you want a space that's very versatile. You don't want something that's like, an out parcel McDonald's, because when McDonald's leaves, it looks like an ugly McDonald's and no one else wants to be there, right? You want something that's very flexible and sort of nondescript that you can kind of reuse for a bunch of different users.
All right, awesome. Thank you. Dennis.
Pretty much everybody who's here would like to have the wherewithal to build a Marriott hotel, but probably doesn't have that wherewithal. So there's two things I would say is, one, there's tons of low-hanging fruit out there. Fill that focus on filling that niche, whether you just want to own the building or operate the business. You know, don't try and compete with the big guys, because those guys have shareholders to answer to and huge overheads. So focus on creating an environment that you can pick off that low-hanging fruit that can't afford to be in that big place, because there's always going to be a big demand there. And the other thing is that while you are taking care of the senior citizen, it's their children who make the decision and pay the bills. So, you know, you go into some of these big places, these really nice places, and they have designer furniture in the lobby and, you know, all these bells and whistles. Well, I assure you, Grandma is not comfortable with designer furniture. She couldn't care less. She doesn't even understand it. But it's all there because they're marketing to the children, and the children are making the choice and paying the bill, and they're picking a place close to where they live, not close to where Grandma came from.
Awesome. Thanks, Dennis. And Scott, let's bring it home.
Ditto to everything that's been said. Obviously, focus is a big thing. You know, what Kevin touched on, the first thing is making sure that you're educated and learning as much as you can and immersing yourself in whatever that is, the niche that you choose or whatever it is that you're planning on doing. My caveat to that is, but not to the point where, you know, you're so scared, you're getting ready and you're aiming, and you're aiming, and you're aiming, and you're aiming, and I'm getting ready to, and I haven't picked my logo, and I haven't picked my company name yet. Just go find deals. And go practice finding deals, you know. So if you're interested in looking at buildings to convert to an assisted living facility, you know, even if you don't know all the lingo, do your studying, do all your homework as much as you can. But even if you don't feel comfortable going all the way, then go contact the owner of a building or an existing facility somewhere where you have no business and you don't want to invest in it, and call them up and start having a conversation so that you're getting comfortable with it. So at the end of the day, it's also action. We can take a lot of information, we can get it all inspired and take a whole slew of notes while we're here for the next couple of days. But everybody wants to be perfectly ready and have investors lined up. And we all know that, you know what, if you have a good deal, the money will follow too, right? So don't be scared about that. And it doesn't mean that you have to take the deal from A to Z. Wholesale it. You know, if you find a good deal that any of us want, then wholesale it to one of us and walk you through the process. Become a passive investor. There's a number of folks in here raising capital. You can be a passive investor in one of these deals.
Or JV, I mean.
Or JV, and
JV.
see what it takes to go from front to back and, you know, I don't want to say right on the coattails, but, you know, go along so you can see what it looks like from A to Z. But take the next step, you know, focus, pick what you want, educate yourself, but not to the degree that you sit back and you don't do anything. So go take action.
Yeah.
Awesome. Kevin, Mark, Dennis, Scott, thank you so much. Great advice. Round of applause for these guys. Thank you so much for joining us.